So throughout this week, we have noticed a few companies that have been cutting their dividends. And so I'm going to be going over a range of companies that I have personally been impacted by the dividend cut, and also taking a look at an article from the BBC in which several banks have put their dividends on hold for 2020. So before I jump in, I just want to give an overview of my portfolio. And so for the companies that I have brought into this week, are the top ones, Main Street Capital shares were brought into that company. I also brought a handful of shares in Realty Income, and I wanted to minimize the loss within Simon Property, and so a couple of shares were brought there as well. So now that we are well and truly within April, I just want to show the dividends that were received within the whole of March. So switching over to a Google spreadsheet that I have, we can see that at the end of March, I had a portfolio value of under 3k, and the dividend amount was just under £8. Now we can see with the current numbers that I've been purchasing a lot more of dividend-based companies, but we can see that my current portfolio is almost double the value it was at the end of March. And with the free funds, I have been purchasing more shares of the companies on the screen. And so naturally, more dividends should be paid out if you hold more of the underlying stock. However, since there have been dividend cuts with a subset of companies, the overall portfolio will fluctuate in terms of the dividend payouts. And also keep in mind that some companies pay dividends monthly, while the majority pay every 3 months. So if you hold more shares in a company that pays dividends every 3 months, then looking at a graph every month is not a true reflection of your portfolio. But nonetheless, dividends have been cut, and in some situations they've been stopped completely. And so we're going to be analysing the impact in terms of how my portfolio will perform going forwards. So last week, back on April the 1st, unfortunately this wasn't an April Fool's joke, but some of the major banks in the UK, which are dividend payers, they all came under pressure to put a hold into paying out dividends to shareholders. Now, I actually hold shares in Lloyds Bank, and it's been hit quite a bit with almost minus 22% loss. We have a current price of under 30 pence, and we can see my average price is around 35 pence. And I have a reasonable chunk of capital within Lloyds Bank, so currently market value of just over £350. So the decision to stop paying out dividends, and this is the same with NatWest, Santander, Barclays, so anyone else who holds any of the major building societies as a shareholder, we're all in the same boat. Now it's easy to say when I'm reading a post that's from the past, but it's no surprise that the likes of Lloyds, etc. cut their dividends. Back in the 2008 financial crisis, when Lloyds was bailed out, their dividends were put on hold, and it took about 8 years until they started paying dividends again. So for any investors that plan on holding any of the UK biggest banks, then you just have to accept and suspect that whenever there is a recession, then there's always a high probability of the dividends not being paid out. So for me, I'm not going to be purchasing any Lloyd shares anymore, but my plan is still to hold those shares. And that's because I have the opinion that Lloyds and other major banks in the UK will survive, and in the future they will allow dividends to be paid out. So the positives are that a lot of these banks are being proactive. They are withholding money that would have otherwise reached shareholders, but instead they can hold on to that financial cushion and finance the company wisely. As a shareholder, we want to see these companies last well into the future, and so I have no issue with an interim period of no dividends being paid. Of course, I have the flexibility to sell out of the positions in the future if I'm unhappy or the dividend payouts take longer than expected. But right now, I'm happy to hold the shares. So we can actually see that there will not be any payouts to shareholders until at least the end of the year. So given that we are only April, that is quite a significant amount of time for dividends to not be paid out. Once we hit 2021, we have no idea if these banks are going to pay out their dividends. And so if anyone does hold a lot of the major banks and that is the highest position in your portfolio, then if you are like me and you focus on dividend investments, then you'll probably want to reconsider and purchase other companies that, at least for the time being, are not slashing their dividends or stopping them completely. So as a shareholder, of course, it's a shame to see dividends being cut. It goes against my individual goals of trying to grow passive income through the form of dividends. But my portfolio is just at the beginning stages. And if we take a look at Lloyds Bank, it's almost at the 7% mark in terms of my overall portfolio. That will naturally come down as I invest into other companies. And so the impact is not that great. So moving on to new residential investments, we can see the dividends were slashed. So before we get into the details, I myself am a holder of new residential investment, and looking at where it stands on the leaderboard, it's slightly higher than my position in Lloyds, so 7.5%. Now, unlike Lloyds, dividends are still being paid out, but the drop is quite significant. And so previously we had payments of 50 cents and they're now been slashed to 5 cents. Now, that is, of course, a significant drop, but the ratio was extraordinarily high, and coupled with the actual market price, so we can see the current price is $3.33, then it made no sense for a company to pay 50 cents when the current market price is just so low. And so it was highly expected that this dividend cut would take place. So the question I have to ask myself is, with respect to new residential investment, what strategy am I going to be taking? So I have new residential investment graph open, and we can see the performance from late February to early April. So when I first purchased the stock, I was purchasing at levels close to $17, and now we have a mere $3.33. And so with the price dropping by around 5 times, what it means is that if we were comfortable buying the shares at this close to $18, then we can buy 5 times as many shares at the lower price point. So that is something to consider. If dividends are still being paid and you are happy with the lower rate, then your money buys, in this case, 5 times more shares, and those additional shares will cushion the impact of the decrease in the dividend cut. Now, of course, that logic doesn't apply for companies that fully stop their dividends, such as the case with Lloyds. But that is why I will still be purchasing into companies that slash their dividends. Now, you have to take it on a case-by-case basis. Are you still happy with the reduction? And of course, even if the stock price is 5 times less, there has been a 90% decrease in the dividends. And so even though I hold more shares in the company, I'm still netting less money in the form of dividends. But as with any type of investment, we buy with the assumption and with the hope that the company will continue in existence. And so at a certain point in time in the future, we will be receiving dividends once again, and we will be happy that we purchased at a much lower price point. So out of all the companies that I hold within my dividend portfolio, those are the known companies that have cut their dividends. Now, not only do I hold individual companies, but I do hold ETFs as well. So take the example of the Vanguard All World High Dividend Yield. Now, this also pays out dividends. And so given that this ETF tracks other types of dividend-based companies, then we're naturally going to see a reduction in the dividends paid out as well. So anyone that holds ETFs, such as a dividend tracker, then expect in the future those dividend payouts will be lower than usual. Now, of course, with the likes of Lloyds and all the other large banking sectors out there, no one that is a shareholder likes to have the dividends cut. And so we can see a slight change in my strategy where I won't be buying any more into Lloyds. And so I am going to continue to dollar cost average. We can see that some of the results are somewhat lower. Before we had 45% reduction. Some of these have come down to under the 40%. So that's an update of dividends being cut. There's a lot of other companies out there, both in the UK and the US, but I've just focused on some of the companies that I've been impacted in and wanted to show some of the proactive approaches that I've been taking since the news came out. So thanks for watching, and with that said, I'll catch you in the next one.